goes on and on and
Hai, Assalamualaikum warahmatullahi wabarakatuh. Good evening to all. My name is Rabiatul Adawiyah binti Muhammad Zain. My chair number is 1210815. So today I will talk and want to show you how to calculate my subtopic of our grouping assignment, which is interest. Firstly, what is interest? For your information, interest is the money paid regularly at the particular rates for the use of the money lends or for delaying the repayments of the debt. To make it clearly, let's say you want to buy a house now 2021, so you take a loan for the lender or banker. You will earn the money of the loan, which also collects as the principal. The next years of the borrowing money 2022, you need to pay another the cost that the lender charged you for the borrowing his or her money, which is called as the interest. Let's assume if the house loan is for 30,000 at 6% interest that the lender charge you, so you will have to repay the 30,000 as well as pay the lender or bank 6% of 30,000, which is 1,800 interest, for a total of 30,800 altogether in 2022. In addition, your lender might give you many months to repay that loan, so you don't have to worry about it. So generally, there are two types of the interest, which is simple interest and compound interest. Simple interest is the interest that is calculated based on the principal. It means that only the principal and interest. For the compound interest is the additions of interest to the principal sum of the loan or deposit, or in other words, interest on interest. Let's focus on the simple interest first. For example, when a person takes a loan of 5,000 at the rate of the 10% for the 2 years, the person's interest for the 2 years will be simple interest on the borrowed money. So 2020 is your original amount or principal of your loan, 5,000. If the bank charge you simple interest, so for the first years of the loan, you need to add 10% of the amount to the 5,000, which is called interest, 500, and for the second years, plus with another 10% of the interest, which is 500 or so. So the total interest for the 2 years of your loan is 1,000. So every year just adding 500. That is how simple interest works. Pay the same amount of interest every year. So formula. So in case you don't know what I equal to PRT is what, so the formula for the simple interest is I equal to PRT, where I is the simple interest, P is the principal, which the amount that initially borrowed from the bank or investor, R is equal to annual simple interest rate, which is the rate of the interest at which the principal amount is given to someone for a certain time, and T is the time is year, which is the durations for which the principal amount is given to someone. So, example, question number 1. Find the simple interest on 3,000 in bank at 4% per year for 6 months. So we can see the question is find the simple interest, so we don't know what is the simple is. So we're looking for I, and remember I is equal to PRT. So what the values of PRT? So P is principal, so there will be 3,000 and will be multiplied with R, which is the rate, and the rate take 4%, and T is year, and for 6 months. Okay, on this case, you need to make it for n half years for 1 per 2 years. So simple interest could be equal to 3,000 times 0.04 times 1 per 2 years, and put in calculation, so you get RM60 for simple interest. So question number 2, James invests 5,000 in a saving account at an annual interest rate of 7% for 5 years. So how much money did earned in interest. So calculation is I equal to PRT. So to find I, simple interest must be equal with principal 5,000 times with 7%, which is 0.07 times with 5 years. So we get simple interest 1,750. So let's move to other types of interest, which is compound interest. So let's assume that we have deposit 10,000 in credit unions, which pay interest of 10% per year compounded quarterly. So we want to determine the amount of the money we will have on deposit at the end of the 1 year if all the interest is left in the saving account. At the end of the first quarter, interest is computed as I equal to PRT, is where the I equal to 10,000 times 0.1 times with 0.25. Why 0.25? Because the question states that combined quarterly. So we get interest for the first quarter is 250. So with the interest left in the account, the principal on which interest is earned in the second quarter is the original principal plus with 250 in interest earned during the first quarter of. To make it clearly, second principal is equal to the first principal plus with first interest, which is first principal is 10,000 plus with the first interest, which is 250. So we get second principal is 10,250. So interest earned during the second quarter is use the new principal for 1 year, which is 10,250. So second interest will be 10,250 times with 0.1 times with 0.25, because instead the compound quarterly, so we use 0.25 every calculation. So the second interest will be 256 ringgit point 25 cent. So formula for the compound interest is P plus I, where P is for accumulate principal and I is interest. So the difference between the compound interest and the simple interest is the accumulated value of the compound interest is higher than the simple interest. So that's all for me. Thank you.
Assalamualaikum warahmatullahi wabarakatuh. My name is Muhammad Amirul Hakim bin Ahmad Sabri. Number matrix 1210840. So today I would like to present the topic is present value. So what is present value? Present value is a formula refers to the application of the time value of money that discounts the future cash flow to arrive at its present day value. The present value formula consists of the present value and future value related to the compound interest. The present value or PV is the initial amount, which is the amount invested, the amount lent, the amount borrowed, or etc. The future value of RFV is the final amount of FV equals to PV plus interest. So next is this present value is very related to the business. So basically in businessmen use this formula to derive their calculate amount of their future investment. For example, if they invested today 10,000, and then in the next 1 year they will get interest which is 10% from their investing. So the future value will be 11,000. Next, present value formula finds application in finance, which is in business, to calculate the present day value of an amount that is received at a future date. The present value formula is derived from the compound interest formula. the compound interest formula is future value equals to present value times by open bracket 1 plus r divided by n closing bracket to the power of n times t. When it's dividing both sides, so the present value formula is present value equals to future value divided by open bracket 1 plus r divided by n closing bracket to the power of nt. So what is the meaning of PV, FV, R, and T? So PV is present value, FV is future value, R is shows the rate of interest, which is percentage divided by 100, and N is the number of time the amount is compounding, and the T is time in years. However, the value of N varies depending on the number of time the amount is compounding. For example, the amount, if it's compounding yearly, so the N will becomes 1. If it's compounded half yearly or semi-annually, it becomes 2. If the amount is compounded quarter yearly, so the N will be 4, and etc. So now let's move to the question 1. Exelson borrowed some amount from a bank at a rate of 10% per annum, compounded annually. If he finished paying his loan by paying 9,000 at the end of 5 years, then what is the amount of loan that he had taken? Round your answer to the nearest thousand. Okay, let's move to the answer. The answer is the future value given is 9,100, and the time is, which is t, is given 5 years, and the n is equal to month, as the amount is compounded annually, which is the amount is compounded 1 times per year. And then the interest rate given is 10% divided by 100, so it will be 0.1. So we substitute all these values we get in the question into the present value formula. So if after we substitute all the value into the present value formula, so therefore the borrowed amount is, we get 6,000. So let's move to the question number 2. Mia Aisara invested some amount in a bank where her amount gets compounded daily at 5% annual interest. What is the amount invested by Mia Aisara if the amount she got after 8 years is 2,980? Round your answer to the nearest thousand. So the answer is the future value given, which is 2,900, and then the time, which is t, equals to 8 years. So n equals to 365. Because why 365? Because it compounded daily, which is every day in a year is compounded every day in 1 year. So 1 year equals to 365 days. So the interest rate given is 5% divided by 100, it becomes 0.05. So we substitute all these values in the present value formula, and then therefore the invested amount is 2,000, which is the present value is 2,000. So for the conclusion for these topics, the present value formula is present value equals to future value divided by open bracket 1 plus r divided by n closing bracket to the power of tn. So that's all from me. Thank you.
Okay, Bismillahirrahmanirrahim. Assalamualaikum warahmatullahi wabarakatuh. So my name is Megan Muhammad Alif bin Muhammad Azmir, and my metric number is 1210823. So today I'm going to talk about future value, which is this topic has a relation with business math. Okay, so without further ado, let's start this topic. Okay, so what is future value? Future value is a value of an asset or its worth in a specific date in the future. Okay, so let's say that I have 500 ringgit and I'm going to save it inside my saving account. And after 2 years, the amount inside my saving account is not 500 anymore because it was added with the interest. So the amount will, in the future, after 2 years, it will increase. Okay, so the amount in the future, that is future value. That is what we call as future value. Okay. All right. So future value, it has a relation with simple interest, and also it has a relation with annual compounding, right? So let's continue. Okay. So this is how we want to find future value in simple interest. Okay. So this is the example of a question which is related with simple interest. Okay, so Razman deposited 300 ringgit at 6% simple interest for 1 year and 6 months. How much he will receive at the end of the term? Okay, so based on the question, it want us to find the future value after 1 year and 6 months. Okay, so this is how we can solve the question. Okay, so S equals to future value because we want to find the future value, right? Okay, so S equals to P open bracket 1 plus RT close bracket. Okay, so P stand for principal, which is the amount that Razman deposited, which is 300 ringgit, and then we open bracket 1 plus RT. Okay, R refers it stand for interest rate. Okay, so in the question it said that 6% simple interest. Okay, so we just change it from percentage form into a point form. Okay, so 6% equals to 0.06. Okay, and then times with t, which is time. Okay, so 1 year and 6 months equals to 1.5 years. Okay, just change it into a point form, right? So just put the value inside the formula. 300 times with open bracket 1 plus 0.06 times 1.5. All right, so we will get 327 as the future value. Okay, so as in the slide, 327 ringgit is the future value after 1 year and 6 months. Okay, so Razman deposited 300 ringgit, and after 1 year and 6 months, he will get the amount is 327 ringgit. Okay, after 1 year and 6 months. All right. So this is how we want to find future value in annual compounding. Okay, so below is annual compounding formula. Okay, S is the future value. So S equals to P open bracket 1 plus J over M close bracket to the power of M times T. Okay, so P is the principal, J is nominal rate, which is the interest percentage. Okay, the interest rate, right? 6%, 5%. Okay, depends on the question. M is compounding frequency in a year. So M is it is depends on how many does the interest calculated per annum. Okay, so if it was compounded quarterly, the M will becomes 4, and if it was compounded monthly, the M will become 12. Okay, all right. So T is time or term in years. Okay, 1 year, 6 year, 5 years. Okay, so S equals to P open bracket 1 plus J over M close bracket to the power of M times T. Right. So this is the annual compounding formula. Okay. As I mentioned before, M is depends on the number of times the interest is calculated per annum, right? If it was compounded daily, so M equals to 365 times per annum, all right? If monthly, the M will become 12 times per annum. If quarterly, the M will become 4 times per annum. And if semi-annually, the M will become 2 times per annum, right? So this is the example question, okay, for finding future value in annual compounding. Okay, so Berjaya Company, which is a small company, has made a long-term investment, 120,000 ringgit, which the interest rate is 10% per year. So 10% equals to 0.1 in point form, right? And the interest is compounded quarterly. Okay, quarterly means M equals to 4, right? Because it was calculated 4 times per annum, right? So if the interest is reinvested at the same rate of interest, what will the value of the investment would be after 6 years? So what is the future value after 6 years, all right? You want us to find after 6 years, what does the amount will be like, all right? Okay, so S equals to the future value, S equals to P, which is principal, open bracket, 1 plus J over M, close bracket, to the power of M times T. Okay, we just need to transfer the value uh, inside the formula, all right? So P equals to 120,000 ringgit, which is the amount that Berjaya Company invests. Open bracket, 1 plus 0.1, which is 10% interest, over 4, which is M, right? It was compounded quarterly, right? Okay. Close bracket, to the power of M times T, which is 4 times 6 years, all right? The T is 6 years, okay? And then after we calculate, we will get 120,000 ringgit times with 1.025 to the power of 24. And lastly, we will get the future value is 217,000 and 47 ringgit and 11 cent. So this is the future value after 6 years. Okay, so Berjaya Company invests 120,000 ringgit. Okay, after 6 years, the amount is 217,000 ringgit, 40 217,047 ringgit and 11 cent. Right, so that is the future value after 6 years. Okay, so that's all from me. I hope that this video can help you to understand more about future value. And so that's all from me, inshallah. Assalamualaikum warahmatullahi wabarakatuh. Thank you.
Bismillahirrahmanirrahim. Assalamualaikum warahmatullahi wabarakatuh. My name is Marsha Maisara binti Muhammad Abdullah with matric number 1210836. I'm from KMB1 and today I will be presenting about annuity. Okay, what is annuity? The definition of annuity is any finite sequence of payments made at fixed periods of time over a given material. And then length of time is considered as payment period, and the given interval is considered as term of annuity. The period of time in the topic of annuity will always be fixed, and the payments or savings that occur will always be equal at every period of time. The amount of payments that will be deposited or paid will always be equal periodically over time. For examples, the examples of usage of annuity is the examples of usage of annuity are shop rentals, annual dividends, insurance policy, and installment payment. Okay, what is concept of annuity actually? What will people use the annuity calculation for? Okay, the annuity concept is actually it can enable people to make an effective plan for the future in terms of savings and investment. The examples of the application of annuity calculations are financial consultants are using annuity calculations to advise people on investments. Secondly, property agent will use annuity calculations to estimate the repayments of housing and car loans. And lastly, last and most importantly, annuity calculations also helps people to make a good decision, especially in aspect of financial. Next, there are two types of annuity cases, which are firstly ordinary annuity and secondly is annuity due. Okay, what is the difference between the two of these cases? Ordinary annuity, in ordinary annuity case, payments are made at the end of every payment period. As you can see in the figure below, the zero in the figure below represents present, which is now. So we can see the R in the figure below actually represent payment. So as we can see, the payment is occurred for every at the end of every period of time. And the example of application of ordinary annuity is sequence of wage payments. The employer, as we already know, the employer usually pay wages to their employees when the work is already done in the period of time. And then secondly is annuity due. Annuity in the annuity due case, payments are made at the beginning of every payment period. And as we can see in the figure below, the R, which represents payments, is occurred at the beginning of every period of time. And as we can see, the end period of time there is no payment because the payment for end period of time is paid at the beginning in under n-1. So for example of the application of annuity due is sequence of rent payments. Usually landlords will demand first month's rent when the tenant firstly moves in. Okay, next we will go with present value. Okay, actually present value and future value concept is very related with annuity topic. So there will be four cases that will be presented in this topic, which because there are two types of concepts that is related with annuity case, and there are two types of annuity cases, which are ordinary annuity and annuity due. So as you can see, the formula stated in the present value formula actually the formula stated is actually a present value of annuity formula. Yes, present value of annuity formula. So the capital of R represents the amount of an annuity for every period of time. Another R represents interest rate per payment period, and N represents time. Present value A. In this topic, the A in the formula represents present value of an annuity. Present value A of an ordinary annuity of R per payment period for n periods at the interest rate of R per period. So let's take a look at types of cases. Okay, firstly, present value of ordinary annuity. So the question says, given an interest rate of 5% compounded annually, find the present value of a generalized annuity of $2,000 due at the end of each year for 3 years. The words at the end of each year already stated that this case is ordinary annuity case. And then $5,000 due thereafter at the end of each year for 4 years. Okay, as you can see, interest rate is 5%, but 5% is for every year. Okay, for every year. And then find the present value of the generalized annuity of $2,000. Okay, so $2,000 is, as you can see in the question, $2,000 is occurred at the end of each year. So $2,000 is R in this case, and 3 years. And then 3 years is also included in N in the formula, and 5,000 here is also considered as R, which is the payment that occurred. The value of an annuity that occurred at every period of time. So $5,000 here occurred at the end of each 4 years. For a clear vision, as you can see in the figure below, at the first, second, and third period of time, $2,000 of an annuity occurred. $2,000 of an annuity is occurred. So and then the 4 years ahead, $5,000 is occurred. Okay, to simplify it, to simplify the calculations, we will consider that $5,000 is occurred at every 7 years. So we just substitute in the formula, considering that $5,000 is an annuity that occurred for every 7 years. So the n in the n word, the n letter in the formula will be 7, and then we will subtract it with 3,000. With $3,000 that occurred for every 3 years, so that we can calculate we can include the calculations of $2,000 that occurred for the first 3 years, for the first each of 3 years. So we just substitute it, and then we will get $20,762.12. Okay, next, present value of annuity due. The question says the premiums on an insurance policy are $50 per quarter, payable at the beginning of each quarter. If the policyholder wishes to pay 1 year's premiums in advance, how much will be paid, provided that the interest rate is 4% compounded quarterly? So in this case, $50 per quarter already stated that $50 is R, which means the payment or savings that occurred for every period of time. And then the interest rate is 4%, but the 4% here is for every year. So the R that represents interest rate in the formula will not be 4%, but it will be 1%, because 4% have to be divided with 4, which means because there are 4 quarters in 1 year. And then N will be, and N in the formula will be 3. Yeah, the question doesn't state that how many years should be paid. That is okay. And then okay. So as you can see in the figure below, the payment the payment of insurance is occurred at the beginning of every period, which is in the zero, which means present, in the first period of time, in the first period, and the second period, and the third period. So okay, actually annuity due is is kind of special case compared to ordinary annuity. So in every case of annuity due in the topic of annuity, there will be an addition in the formula because annuity due is such a special case. Okay, so as we can see, there is 50 in the orange box. As you can see that firstly we have to add the 50, which is the first payment, and then add with annuity that has been substituted in the formula, because the first payment is also included in the annuity due formula. In this kind of case, first payment is also included. And why it is not included in the formula? Because there is no interest rate occurred at the first payment in 0 period of time. Oh, I'm sorry, it was my mistake. That means there are 4 periods of time. In this case, there are 4 periods of time because there are 4 times payments occurred. Yes. And another addition in the formula of annuity due is, as we can see in the yellow box, the n in the formula will have to subtract with 1. Yes. We have to subtract with 1. Okay, so we just have to substitute it, and then we will get $197.05. So next is future value. Future value, okay, this is the formula of future value. It is different compared to present value of an annuity formula. So, but the letters in the formula represent the same thing as the present value formula. So the capital of R represents the amount of an annuity for every period of time, and another R represents interest rate per payment period, and N represents time. Future value S here we consider is as S. If present value we consider it as A. Future value S of an ordinary annuity of R dollars per payment period for N periods at the interest rate of R per period. Okay, so let's take a look at the future value of ordinary annuity. Find the future value of an annuity consisting of payments of $50 at the end of every 3 months. Okay, at the end of every 3 months means already indicates that this case is ordinary annuity. At the end of every 3 months for 3 years at the rate of 6% compounded quarterly. Also find the compound interest. Okay, so the $50 that occurred at the end of every period of time is R. Represent the capital of R because it is the payment that occurred for every period of time. And then interest rate is not 6% because 6% is for every year. So 6% we have to divide it with 4 because there are 4 quarters in every year. So the interest rate that will be the value of interest rate that will have to be in the formula is 0.015. Yes, because 6% divided with 4, and then the n is the n in the formula is 12 because 3 years multiplied with 4 quarters that occurred for every year, so it will be 12. So we just have to substitute it. So and then we will get $652.06. And additional answer for the additional question, find the compound interest. Okay, compound interest is the difference between the amount of the annuity, which is $652.06, and the sum of the payments. Okay, so the amount of annuity we already get, and then the sum of the payments. How could we find it? The sum of the payments, we will multiple the period of time and periods of time with payment that occurred for every period of time, which is 12 periods multiple with $50 that occurred for every quarter, for every period of time. So, and then we will get 600, and then you just have to subtract it with the amount of annuity, and then we will get $52.06, and this is the total of compound interest. Yes. And then next we will go to future value of annuity due. Okay, the question says at the beginning of each quarter, $50 is deposited into a savings account that pays 6% compounded quarterly. Find the balance in the account at the end of 3 years. Okay, so the words at the beginning already indicates that this case is an annuity due case. Okay, so $50 that deposited quarterly is R, because it is the payment that occurred for every period of time, and then 6% is the interest rate. But 6% is not the value that we have to substitute in the formula, because 6% is the interest rate that occurred for every year. So we have to divide it with 4, because there are 4 quarters in 1 year. So 6% divided with 4, we will get 0.015. So that's the value of interest rate that we should substitute it in the formula. So the capital of R will be $50, and the interest rate will be 0.015, and N will be there are in this question there are 12 periods of time, but as I said before, there are some additionals in the formula when it comes to annuity due case. So as we can see in the light blue box besides the next to the orange arrow, the N in the formula will add 1, and in the bracket, as you can see, we will have to subtract it with 1. It is because we have after substitute all the values in the formula, we will have to subtract it with the $50, with the final payment, which is $50 in this question. So yes, so that's why there is subtraction in the formula of annuity due case. So we just have to, as you can see in the figure below, the payment or the savings deposited at the beginning for every period of time, and then we just have to substitute it. As you can see, there are 12 periods. Yes, there are 12 periods, and then we just have to substitute it yes, and then we will have as you can see after we add N with 1, it will be 13. But still, the periods in this question is actually 12. But we have to add 1 in the case of annuity. As you can see in the formula, we have to add 1 in the N in N. So we just have to substitute it, and then we will get $661.84. Okay, next, lastly, the special case in the topic of annuity is sinking fund. Okay, the question says, suppose a machine costing $7,000 is to be replaced at the end of 8 years, at which time it will have a salvage value of $700. In order to provide money at that time for a new machine costing the same amount, a sinking fund is set up. The amount in the fund at the end of 8 years is to be the difference between the replacement cost, which is the $700, and the salvage value, which is 700. The replacement cost will be $7,000 and the salvage value will be $700. If equal payments are placed in the fund at the end of each quarter, as you can see, at the end of each quarter already states that this is ordinary annuity pay, and the fund earns 8% compounded quarterly. What should each payment be? Okay, as you can see, there is a machine that costing $7,000, and the salvage value after 8 years will be $700. So we will have to calculate what is the value of payment that should be placed in the fund for every period of time in order to have enough money to buy a new machine with the same cost. Okay, in this case, the amount needed after, as you can see in the white box below, the amount needed after 8 years is $6,300 because we have to subtract the $7,000 and $700. That's because at the end of 8 years, we will have $700 in our hands, so we will need another $6,300 to buy a machine that also costs $7,000. Yes. So $6,300 will be S, which is future value, which means the total value of dollars that we need more to buy a $7,000 new machine. And then N in the formula will be 32 because 8 years multiple with 4 quarters, because there are 4 quarters in every year, so there will be 32 periods of time. And then the interest rate will be 2% because 8% interest rate in the question to be divided with 4. Because there are 4 quarters in every year, so the interest rate for every period of time, which is also for every quarter, is 2%. So in this case, we have to find R because R represents the payment or savings that occurred for every period of time. So we have to calculate how many dollars of payments that we have to place in the fund for each quarter. So that's why we have to find R. So we just have to substitute all the information that we have found in the formula except R because we didn't find R yet. So 6,300 will be S, which is future value, and the N will be 32 periods of time, and the interest rate will be 2% or 0.02. And we just calculate it, and then we will get $142.45. Okay, that's all from me. Thank you so much. Assalamualaikum warahmatullahi wabarakatuh.
Bismillahirrahmanirrahim. Assalamualaikum warahmatullahi wabarakatuh. My name is Muhammad Akil Aziz bin Muhammad Zailani. My metric number is 1210841, and today I am going to show you what is amortization and how to calculate it. What is amortization? Amortization is an accounting technique used to periodically lower the book value of a loan or an intangible asset over a set period of time. Concerning a loan, amortization focuses on spreading out loan payments over time. When applied to an asset, amortization is similar to depreciation. The term amortization refers to two situations. First, amortization is used in the process of paying off debt through regular principal and interest payments over time. And an amortization schedule is used to reduce the current balance on a loan, for example, a mortgage or a car loan, through installment payments. Second, amortization can also refer to the spreading out of capital expenses related to intangible assets over a specific duration, usually over the asset's useful life for accounting and tax purposes. But today, I'm going to show you how to calculate for the first situation, which is the process of paying off debt. Here, we could see the amortization formula. An amortization calculation is actually depends on the principal, rate of interest, and time period of the loan. Amortization can be done manually or by Excel formula, for both are different. Now, let's see how to calculate amortization manually. Monthly payment, for example, can be calculated by this formula. From the formula, we could see that P is principal, R the rate of interest, T the time in terms of year, and N monthly payment in a year. Now let's do the math. From the questions, a salaried person took home loan from a bank of $300,000 at the rate of interest of 8 years for a period of 25 years. Now we have to calculate the equated monthly installment, or as known as AMI amount, and interest component paid to the bank. From the statement given, we could say that P, or the principal, is equals to $300,000, R, or the rate of interest, is 8%, or we could say as 0.08, and T, which is the time in terms of year, is 25, and N, or monthly payment in a year, is 12. Now let's calculate the equated monthly installment. To solve the problem, we only need to insert the value given into the formula, which is the equation or the amortization formula. Therefore, R 0.08 times with 300,000 over 12 times bracket 1 minus 1 plus 0.08 over 12 to the power of 12 negative 12 times 25. And the final answer is $2,315.4124. Therefore, the equated monthly installment, or AMI, or monthly payment, is $2,315.41. And now, to calculate the interest component paid to the bank, or the interest paid, we will put the values into the interest formula, which is monthly payment in a year times the equated monthly installment times time in terms of year minus principal. Thus, we will get 12 times $2,315.4124 times 25 minus 300,000. The final answer will be $394,623.72. And that's all from me. Thank you for your attention, and Assalamu alaikum warahmatullahi wabarakatuh.